Right now, global markets are standing at one of the most fascinating crossroads of the modern financial era. On one side, investors are watching an extraordinary technology boom unfold. Artificial intelligence is driving demand for semiconductors, data centers, energy infrastructure, cloud computing, and next-generation productivity. Corporate earnings remain strong. Major stock indexes are pushing toward record highs. The appetite for innovation is alive and powerful. But on the other side, the world is confronting a very different force: geopolitical instability, elevated oil prices, inflation risk, and rising bond yields. Today, Friday, May 22, 2026, the Dow Jones Industrial Average reached a record high. Canada's TSX also reached a new record. European technology shares moved higher. Japan surged on enthusiasm around AI, yet beneath the surface, oil remains above $100 per barrel, bond markets remain nervous, and central banks are being forced to think carefully about whether inflation is truly under control. This is not simply a stock market rally. This is a battle between two massive forces: the AI productivity boom and the energy inflation shock. And whichever force becomes stronger could define the next major chapter for global wealth, currencies, interest rates, and investment opportunities. Today, we are going around the world to understand what is really driving the markets, what investors are watching next, and what this moment means for anyone building wealth in 2026 and beyond. Global markets are rising today because investors are beginning to believe that the worst geopolitical outcomes may be avoided. Reuters reports that investors are closely following progress in talks connected to the ongoing conflict involving the United States and Iran. The reason this matters so much to financial markets is simple: energy. The Strait of Hormuz is one of the most strategically important oil transit routes in the world. When fears rise around disruption, crude oil prices rise. When oil prices rise sharply, inflation pressures return. And when inflation pressures return, central banks have less freedom to lower interest rates. That chain reaction affects almost everything: mortgage rates, corporate borrowing, government debt, stock valuations, consumer spending, currencies, gold, crypto, and ultimately, the cost of living. Today, markets are expressing cautious optimism. Stocks are rising because investors see the possibility of reduced tensions. But oil is still elevated because no final resolution has removed the risk. That creates a market environment best described as risk-on, with a warning label. Investors still want exposure to growth, especially artificial intelligence and technology. But they are no longer ignoring inflation, energy prices, or political instability. That is the defining feature of global markets today. The market is optimistic, but it is not relaxed. Let's begin in the United States, because Wall Street is still the center of gravity for global financial markets. Today, the Dow Jones Industrial Average reached a record high for the first time since the Iran conflict began earlier this year. The S&P 500 and Nasdaq also advanced, supported by semiconductor stocks and large technology companies. Just one day earlier, the S&P 500 closed at 7,145.72, the Dow finished above 50,285, and the Nasdaq ended above 26,293. These levels show how much investor confidence has remained intact, despite energy shocks and geopolitical anxiety. Why? Because corporate America continues to produce earnings, and increasingly the market believes that artificial intelligence is no longer just a story about software companies or chatbots. AI is becoming an infrastructure build-out. Every major AI system requires enormous amounts of computing power. That means advanced chips, that means memory, that means electricity, that means cooling systems, that means data centers, that means transmission infrastructure, that means industrial equipment, that means cybersecurity. and eventually, robotics and automation. This is why investors are not only buying famous technology companies, they are also searching for the companies that power the AI economy behind the scenes. UBS Global Wealth Management raised its 2026 year-end forecast for the S&P 500 from 7,500 to 7,900, citing resilient consumer spending and rising demand for AI-driven data center infrastructure. UBS also raised its expected 2026 S&P 500 earnings per share estimate from $310 to $335. That matters because stock markets ultimately need profits to justify higher prices. A market powered only by excitement can collapse quickly. A market powered by rising profits can stay stronger for longer. And right now, Wall Street believes AI is creating real earnings momentum. But there is a major tension hiding beneath the optimism. The same AI boom that is helping the stock market is also creating massive demand for energy, infrastructure, and capital. Meanwhile, oil prices are already elevated because of geopolitical instability. So, the question for Wall Street is no longer simply, will AI grow? The question is, can AI-driven growth remain strong enough to overcome inflation, high interest rates, and expensive energy? That is the real contest unfolding inside the S&P 500. And as earnings season begins to wind down, investors may soon have fewer corporate success stories to focus on and more time to confront the macroeconomic risks. Next week, markets will be paying especially close attention to inflation data, including the United States Personal Consumption Expenditures Index, often called the PCE inflation report. That measure is closely watched by the Federal Reserve. A cooler inflation reading could support the stock market rally. A hotter inflation reading, particularly one influenced by energy costs, could remind investors that record highs do not eliminate risk. One of the most important stories in financial markets today is not as exciting as AI, Bitcoin, or record stock indexes. It is the bond market. Bonds may not dominate social media headlines, but bond yields influence nearly every major asset class in the world. When government bond yields rise, borrowing becomes more expensive. Companies pay more to finance expansion. Home buyers face higher mortgage rates. Governments pay more interest on debt. Investors begin comparing stock market returns against safer fixed income alternatives. And when yields rise too far, too quickly, they can place pressure on even the strongest stock market rally. This week, long-term U.S. Treasury yields climbed sharply as investors worried that elevated oil prices could feed inflation and potentially force central banks to remain restrictive. According to Reuters, global equity funds recorded their first weekly outflow in 9 weeks, with investors withdrawing a net $6.13 billion in the week ending May 20th. At the same time, global bond funds attracted nearly $21.9 billion. That tells us something important. Investors are not abandoning markets completely. They are repositioning. They still want technology exposure. Technology sector funds continue to attract new money, but investors are also becoming more selective and more conscious of risk. This is exactly what happens when the market moves from a simple growth rally into a more complicated environment. In a simple bull market, investors buy almost everything. In a more mature and uncertain market, investors begin asking, which companies have real profits? Which industries can pass on higher costs? Which assets protect against inflation? Which countries benefit from higher commodity prices? Which stocks are dangerously dependent on lower interest rates? The bond market is effectively forcing investors to become more disciplined, and this may be healthy in the long run, because a market based on earnings, productivity, and durable cash flow is stronger than a market based entirely on speculation. If artificial intelligence is the market's engine of optimism, oil is the market's source of anxiety. Brent crude was trading around $105 per barrel today as investors monitored geopolitical developments involving Iran and the United States. U.S. crude was also elevated, near the upper $90 range. Oil matters because it touches almost every corner of the global economy. Oil fuels transportation. Oil influences shipping. Oil affects airline costs. Oil influences food distribution. Oil impacts manufacturing. Oil changes household gasoline expenses. Oil can reshape inflation expectations across the entire world. When oil moves sharply higher, consumers feel it directly. A household paying more at the gas pump has less money available for restaurants, travel, technology upgrades, clothing, or investments. A business paying more for shipping and energy has to absorb the cost or pass it on through higher prices. A central bank watching inflation rise because of energy must decide whether it can continue supporting growth, or whether it needs to remain cautious. This is why today's stock market optimism depends heavily on what happens next in oil. There are essentially two scenarios. In the first scenario, diplomacy improves, energy disruption fears ease, and oil prices begin moving down. In that case, inflation fears could cool, bond yields could stabilize, and stock markets could have room to keep climbing. In the second scenario, tensions worsen or supply risks remain unresolved. Oil could stay elevated or rise further. In that case, the market may be forced to price in higher inflation, fewer rate cuts, or even renewed rate hike expectations. That would be a much more difficult environment for high-valuation growth stocks, consumers, and indebted economies. The lesson is clear. In 2026, you cannot understand global markets by looking only at stock charts. You must watch energy. Because right now, oil is not just a commodity. Oil is a signal for inflation. Oil is a signal for central banks. Oil is a signal for consumer confidence. And oil is a signal for the durability of this market rally. Periods of geopolitical uncertainty often raise interest in alternative stores of value. Two assets frequently discussed in that conversation are gold and Bitcoin. But today, they are responding differently. Gold remains historically elevated, trading near $4,220 per ounce during today's session. Yet Reuters reported that gold was heading toward a second weekly decline, pressured by a stronger US dollar and concerns that high oil prices could keep interest rates elevated. This may seem surprising. Many people assume that whenever geopolitical tension rises, gold must immediately rise as well. But gold does not react to only one force. Gold can benefit from fear and uncertainty. But gold can also face pressure when the US dollar strengthens, and because gold does not produce interest income, it can struggle when bond yields become more attractive. That is exactly the push and pull happening now. Investors still see value in gold as a defensive asset. In fact, gold and precious metals funds attracted new money for a second consecutive week. But in the short term, higher yields and dollar strength are limiting gold's momentum. Bitcoin, meanwhile, was trading around $76,600 today, down modestly during the session. Bitcoin increasingly trades as a unique hybrid asset. Sometimes it acts like a risk-on technology asset, moving with liquidity and investor appetite. Sometimes it attracts investors seeking an alternative to traditional currencies and financial systems. And sometimes it simply reflects its own adoption cycles, leverage, and market sentiment. The important point is not that gold and Bitcoin are identical. They are not. The point is that global investors are increasingly thinking beyond ordinary stocks and bonds. In a world of geopolitical shocks, currency uncertainty, elevated government debt, and rapid technological change, alternative assets are becoming part of a wider conversation about preserving purchasing power and building diversified portfolios. But every asset carries risk. Gold can fall when yields rise. Bitcoin can be extremely volatile. Oil can reverse suddenly on diplomacy. Technology stocks can fall even when the long-term story remains strong. The intelligent investor does not chase every headline. The intelligent investor understands the role each asset plays and manages risk accordingly. For Canadian investors, today is especially significant. Canada's S&P/TSX Composite Index reached a record high, rising to approximately 34,479 points during the session. That milestone reflects several forces working together. Canada has strong exposure to financial companies, energy producers, materials businesses, and increasingly important technology companies. In the current environment, several of those sectors are receiving support. Higher energy prices can benefit parts of Canada's oil and gas industry. Strong equity markets can support financial services. Technology enthusiasm can support Canadian innovation and software companies. And Canada's broader resource exposure can make the market attractive when investors are thinking about inflation and real assets. But Canada is also facing meaningful challenges. The Bank of Canada held its policy interest rate at 2.25% at its April 29 meeting. The bank stated that inflation had moved higher because of oil price increases linked to the Middle East conflict, while the Canadian economy continues adjusting to U.S. tariffs. That creates a complicated situation. Canada can benefit from higher energy revenues in parts of the economy, but Canadian households can still be hurt by higher fuel costs, expensive groceries, and persistent inflation. Today, Canadian retail sales data showed that sales rose 0.9% in March to approximately $72.67 billion, and supported in part by gasoline and fuel sales as pump prices increased. So a higher TSX does not automatically mean every Canadian household feels wealthier. This is the difference between the stock market and the everyday economy. The market reflects corporate profits, investor expectations, and sector performance. The household economy reflects wages, mortgage payments, rent, groceries, fuel, and purchasing power. For Canadian investors, the next major event to watch is the Bank of Canada's interest rate announcement on June 10, 2026. If energy-driven inflation remains elevated, the bank may need to stay cautious. If inflation pressure begins easing and growth weakens, the bank may gain more flexibility. Either way, Canada is in a unique position in this global market cycle, exposed to commodities, connected deeply to the United States, and increasingly participating in technology-driven investment themes. Across Europe, markets also advanced today. The Pan-European STOXX 600 rose to more than a two-week high, gaining around 0.6%, with technology companies helping lead the move. European semiconductor and technology-linked companies have benefited from the same AI infrastructure story driving U.S. markets. Businesses connected to advanced chips, electrical equipment, grid infrastructure, and industrial automation are attracting investor attention because AI is not only a Silicon Valley trend. AI is becoming a global industrial investment cycle. Europe has important companies positioned around semiconductor manufacturing equipment, power infrastructure, electrification, and industrial engineering. Those companies could benefit as data center demand expands globally. But Europe faces a particular vulnerability: energy prices. European economies remain highly sensitive to energy disruption and imported fuel costs. High oil prices can weigh on consumers, squeeze manufacturers, and complicate central bank decisions. That means any sustained easing of Middle East tensions could be especially supportive for European markets. Less energy risk could mean lower inflation pressure. Lower inflation pressure could give consumers more room to spend. And a more stable economic backdrop could allow Europe's technology and industrial companies to receive more investor attention. At the same time, parts of the European economy are showing stress. In the United Kingdom, retail sales weakened as consumers reduced fuel purchases amid cost of living pressure. So Europe's story is similar to America's, but with even greater sensitivity to energy. Technology provides the upside, energy remains the threat, and whichever one dominates in the months ahead will influence whether Europe's latest market gains become the beginning of a durable recovery, or simply another temporary rally inside a volatile year. In Asia, Japan delivered one of the strongest major market performances today. Japan's Nikkei index rose approximately 2.8%, driven partly by investor enthusiasm around artificial intelligence and technology-linked companies. This is important because the AI investment theme is no longer concentrated solely in American mega-cap companies. Asia plays a central role in the global technology supply chain. Semiconductors, advanced manufacturing, robotics, electronics, industrial automation, memory chips, precision equipment. All of these industries are becoming strategically important as the world races to build the infrastructure needed for artificial intelligence. Japan is particularly interesting because it combines manufacturing expertise, robotics capability, and globally recognized industrial companies. But Asian markets are also navigating currency pressure. Reuters reported that the Japanese yen remained weak, approaching the sensitive level of 160 yen per US dollar. A weaker yen can support Japanese exporters because overseas earnings translate into more yen. But it can also raise the cost of imported energy and increase pressure on consumers. Once again, the global market story returns to the same central tension. Technology growth is lifting investors' expectations. Energy and currency pressure are raising the cost of that growth. Asia is essential to watch because it is where much of the physical technology economy is built. Software may capture attention, but chips, machinery, robotics, and manufacturing capacity are what turn digital ambition into real-world economic power. One asset quietly connecting every market story today is the US dollar. The dollar has remained near recent highs as investors balance geopolitical risk, elevated treasury yields, and expectations about central bank policy. Why does the dollar matter? Because the US dollar is still deeply embedded in global finance and trade. Many commodities, including oil, are priced in dollars. Many governments and corporations borrow in dollars. Investors worldwide hold dollar-denominated assets. When fear rises, global money often seeks safety in the dollar and US financial markets. A stronger dollar can be supportive for American purchasing power abroad, but it can create pressure elsewhere. For countries importing energy, a stronger dollar can make oil more expensive in local currency terms. For emerging markets carrying dollar debt, a stronger dollar can make repayments more difficult. For gold, a stronger dollar can create a headwind. For Canadian investors, currency movements can influence the returns earned from US assets. This is why markets are interconnected. Oil influences inflation. Inflation influences central banks. Central banks influence bond yields. Bond yields influence the dollar. The dollar influences global purchasing power, commodities, and investment flows. There is no single isolated market anymore. Global finance behaves more like an operating system. Every major variable affects the others. And today, the dollar is telling us that investors may be optimistic about stocks, but they still want protection against uncertainty. The next major stage of this market story belongs to central banks. In the United States, Federal Reserve officials must decide whether inflation is cooling enough to support easier policy, or whether elevated energy prices are creating renewed inflation risks. Minutes from the Federal Reserve's April meeting indicated that total PCE inflation was estimated at 3.5% in March, boosted by a sharp increase in energy prices, while core PCE inflation was estimated at 3.2%. Those numbers matter because they show that inflation pressure has not disappeared. The Federal Reserve's next scheduled policy meeting takes place on June 16th and June 17th, 2026. Before that meeting, investors will receive more inflation and economic data, including closely watched PCE figures. In Canada, the Bank of Canada faces a similar challenge. Its next scheduled interest rate announcement takes place on June 10, 2026. The bank has acknowledged that higher oil prices have pushed inflation upward, even as the economy adjusts to trade pressures. Central banks now face a difficult balancing act. If they keep rates too high for too long, they risk slowing economic growth and damaging consumers and businesses. But if they loosen policy too quickly while energy prices remain elevated, inflation could become harder to control. This is why every oil price movement, inflation report, and geopolitical headline matters so much right now. Markets are not simply guessing which stock will rise next. Markets are trying to understand the future cost of money. And the future cost of money affects nearly everything. So, what should investors and market watchers focus on from here? There are 5 major signals. Signal number 1, oil prices. Oil remains the fastest way for geopolitical instability to become an economic problem. If Brent crude begins moving decisively lower, markets may interpret that as relief for inflation and consumers. If oil remains above $100 or climbs higher, bond yields and central bank anxiety may remain elevated. Signal number 2, inflation data. Next week's US PCE inflation report could strongly influence the market's expectations for Federal Reserve policy. Investors want confirmation that inflation is stabilizing, but elevated energy prices could complicate that story. Signal number 3, artificial intelligence earnings. AI remains one of the strongest drivers of global stock market optimism. Investors will continue looking for proof that demand for chips, data centers, power infrastructure, software, and industrial technology is producing real revenue and real profits. Signal number 4. Central bank decisions. The Bank of Canada announces its next rate decision on June 10th. The Federal Reserve concludes its next meeting on June 17th. These decisions could influence the Canadian dollar, US dollar, bond yields, technology valuations, mortgages, and broader market sentiment. Signal number 5. Global diplomacy and energy routes. Markets are paying close attention to any development that could reduce or worsen risk around Middle East energy supply and shipping routes. A durable diplomatic breakthrough could calm markets. A breakdown in talks could rapidly change the mood. That is why investors need to stay informed without becoming emotional. Headlines move quickly. A financial plan should not. A strong investor observes the world, understands the risk, remains diversified, and avoids making desperate decisions based on fear or excitement alone. There is a deeper story behind today's market movement. We are living through an economic transition. The old world was built around oil, industrial manufacturing, traditional banking, and centralized communication. The emerging world is being built around artificial intelligence, data centers, advanced semiconductors, robotics, digital assets, energy infrastructure, and programmable financial systems. But the new world cannot fully escape the old one. AI still requires energy. Digital economies still require physical infrastructure. Technology companies still need financing. Consumers still need affordable food and fuel. Governments still need stable currencies. And markets still depend on confidence. That is what makes 2026 so important. It is not simply a year where technology stocks are rising. It is a year where the world is discovering how expensive the future may be to build, and how powerful the opportunities may become for those positioned intelligently. The investors who succeed in this environment may not be the ones chasing the loudest stock or the fastest moving headline. They may be the investors who understand the major structural forces: artificial intelligence, energy security, interest rates, inflation, global supply chains, digital assets, infrastructure, and disciplined long-term ownership. Because wealth is rarely built by predicting every daily movement. Wealth is built by understanding the direction of the world and patiently owning assets connected to that direction. Global markets today are powerful, optimistic, and deeply uncertain at the same time. Stocks are reaching new highs. AI is transforming industries. Canada is participating in the rally. Oil is testing inflation. Central banks are watching closely. And investors everywhere are trying to understand what comes next. This is not a moment for panic. It is a moment for awareness. Pay attention to the signals. Understand the forces. Build your knowledge. Manage your risk. And remember, markets reward patience, preparation, and perspective. Subscribe for more breakdowns on global markets, artificial intelligence, cryptocurrency, technology, and the future of wealth. Because the future is being priced in today.